started.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast here from the shores of Lake Tahoe. So, after a string of fantastic guests and a lot of engaging conversations, I'm going to go solo, roll solo this week, and take that opportunity to touch on the recent market performance and investment environment that investors are currently facing, as it's an interesting one. Markets have posted a strong 12% return year to date, with markets rallying recently with the suspension of the debt ceiling, while the Fed continues to signal that it may pause its rate hiking cycle and not hike rates during next week's meeting. That's all provided a boost for equities in recent months. In fact, the S&P 500 is up nearly 20% from its October low, signaling it is nearing a bull market. So before I get started, I'd like to thank today's sponsor. Today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. So let's go ahead and start by taking a look at some market indicators that I like to follow. The first one, which is very interesting, is the equal weighted versus cap weighted S&P 500. While the broad equity market, like I said, has performed very well, over 12% year to date, nearing a bull market from its October lows. The performance has really been driven largely by a small concentration of tech stocks, particularly AI and semiconductors, which have really dominated U.S. equity returns lately. Don't remind me, we've heard this story before, back at the end or during the pandemic. The cap-weighted version of the S&P 500 has outperformed the equal-weighted version of the S&P 500 by nearly 26% over the past 3 months. And that is the biggest outperformance since the late 90s. And we all recall what happened next. It was the dot-com bubble bursting, the last time we had an outperformance between the cap-weighted index and the equal-weighted index. So this is probably not a surprise when you consider the fantastic performance of the Magnificent Seven recently. And that Magnificent Seven includes Apple, Microsoft, Alphabet, Amazon, Tesla, NVIDIA, and Meta. They have really driven the performance of the traditional cap-weighted S&P 500. And it comes no surprise that those big names are all tech related. And that brings me to the next point: small caps versus technology stocks. Small caps have not experienced this big of a 3-month underperformance compared to tech stocks since the peak of the pandemic. Last week, I had on John Christensen, who is a portfolio manager of Kane Anderson Rudnick, and he discussed that small caps perform better during easy monetary policies, right? And that is also the case with tech names. So this huge outperformance by tech names is a little interesting when you consider those two asset classes. But when you dig a little bit deeper and you think, well, small caps have struggled with the regional banking crisis, while tech names have really performed well and been driven by, like I said, the emergence of AI, semiconductors, NVIDIA posting blowout numbers. So it's not overly surprising when you take it all into consideration. Then you have growth versus value. On a 3-month rolling return basis, growth stocks have experienced their biggest outperformance compared to value stocks since the peak of the pandemic. And we all recall how tech stocks dominated the market landscape back then, and they're dominating the investment landscape today. So now hopes of a falling interest rates have boosted growth names again, while recently, or over the past year or so, value stocks experienced solid outperformance while the Fed was hiking its interest rate. Then taking a step further, you have the equity and bond correlation, which is interesting. That the 12-month correlation between the S&P 500 and Bloomberg Aggregate Index is at 0.75, which marks its highest since the 90s. So when you have a correlation between equities and bonds, which are typically, uncorrelated assets, it makes it very difficult to create diversified investment portfolios. Taking a step further and looking more at a macro level of the investment landscape, you have the CBOE equity put call ratio, which is something I really like to look at when looking at investor sentiment. After spiking well above 2 in December, the equity put call ratio has fallen to 0.5, which means traders are buying more calls than puts, which means traders are bullish. In fact, the current ratio sits well below the 200-day moving average of 0.75. Another investor sentiment index I like to follow is the AAII Bull Bear Sentiment Index. Interestingly, while the put call ratio is trending bullish, the spread between the number of bears versus bulls has narrowed recently, meaning that the survey respondents are growing more bearish since the middle of March. When we're talking about the next couple indicators, it's important to take into effect the 10-year yield. 10-year yield started or 10-year treasury yield started the year at 3.88% and just closed at 3.69%. While it's fallen nearly 20 basis points, it's been a volatile ride with yields climbing to as high as 4.08% along the way. So it's important to keep that in the back of your mind as we talk some more about some of these upcoming indicators. A very popular indicator is the relationship between copper and gold. During economic expansions, the price of copper increases. Meanwhile, gold, which is the ultimate insurance play, does much better during times of economic softness or signs of a recession ahead. Since the beginning of this year, the copper to gold ratio has been trending downward, in a sign investors believe economic weakness lies ahead. However, that ratio has bounced off its lows since the second half of May and has really started to climb back, signaling that optimism for the economy is starting to build and that the price of copper is increasing as economic expansion might be ahead on the horizon. Another one is transportation versus utilities. That relationship between the transportation and utility sector is another one I really like to follow when getting a sense of the economy. When the economy is strengthening, transportation stocks should perform well. Conversely, strengthening economy results in higher interest rates, which typically means utilities underperform. So since the bottoming in April, that ratio between transports and utilities has spiked, indicating markets believe the economy will expand. Meanwhile, 10-year yields have also increased by roughly 30 basis points during that time period. Equity dividend yields. While the 10-year treasury yields have spiked over the past couple of years, equity dividend yields have fallen slightly, which has resulted in the dividend yield spread falling to multi-year lows. This is also providing investors with some safer alternatives when looking for income. For a while, there was no alternative to equities. It was TINA, right? There is no alternative. Now that's changed. Real yields have climbed and have made it much more attractive compared to the riskier dividend yield. Speaking of yields, and lastly, yield spreads. High yield bonds have fallen nearly 90 basis points since March, which signals investors aren't concerned about the economy or a potential credit crunch. High yield spreads spiked last year and into this year, but have really come down since March, which might be a surprise considering we had the concerns about the debt ceiling, and we also had concerns about the regional banking crisis or the health of the banking sector. Despite all that, high yield bonds have fallen. So with all that being said, one thing we have come to realize over the past few months is how quickly or overcrowded trades can unwind. These trades become very crowded as people don't want to miss out on returns. Once those trades get crowded, they can unwind just as quickly as they become crowded. So I'm not saying the big growth, particularly the concentrated tech trade, is overcrowded. However, if the Fed decides to surprise markets and raise rates more this year, the trade may unwind very quickly, and you don't want to be on the wrong side of that trade. Speaking of the Fed, recently the Fed has been dovish and signaling a pause in rate hikes may start as soon as next week. So while I believe the Fed is going to keep rates unchanged during their FOMC meeting next week, recent economic data suggests the Fed's work is not done, and it may need to continue to raise rates again this year. The labor market remains very strong. Job openings climbed in April following 3 months of declines. The May jobs report was mixed, but job growth blew past expectations, while the unemployment rate rose from 3.4 to 3.7%. Additionally, inflation. You can't talk about the Fed and monetary policy without talking about inflation. While cooling some, inflation still remains stubbornly high and rose 0.4% during the month of April. So when you consider that strong equity performance has been driven by a very small concentration of stocks, and the Fed may not be done with its rate hiking cycle, there is potential for some weakness in equities ahead. So in closing, I am off to spend nearly a week in Nashville attending the CMA Music Fest, which is going to be fantastic. I'm really excited for it. It's going to be a fantastic time. If you've ever been in Nashville, you know how much fun it is. I'm excited for it. But honestly, I'm a little concerned if my body can survive a week of honky tonks, live music, late nights, humidity, heat, and what comes with all that fun. I have been sure to starting to hydrate now to be ready for the week of fun in Nashville. So I'm sure I'm going to give my body a test, and I will let you know how I fare next week. So thank you all for listening to this episode and watching this episode of the Zephyr's Adjusted for Risk podcast. You can watch the episode on our Adjusted for Risk YouTube channel, as well as listen to it on Spotify or iHeartRadio. With that, thank you very much and have a great rest of your week.